Quizás podamos pasar a la siguiente pregunta. Tercera pregunta. Nos vamos ahora a la deuda emergente. Dentro de la deuda emergente, ¿cuál de las siguientes categorías piensan ustedes que se comportará mejor en el 2013? ¿La deuda emergente emitida en dólares o en hard currency? ¿La deuda emergente en divisa local? ¿Los bonos ligados a la inflación emergente? O, por último, la cuarta respuesta, la deuda corporativa de países emergentes. Veo que estáis contestando, lo único recordad a los que están contestando siempre validar su respuesta con el botón de OK. Última pregunta. En la bolsa europea, ¿cuál de las siguientes zonas geográficas piensan ustedes que se comportará mejor en el 2013? Respuesta 1, teníamos que darle el toque local. España. ¿Se comportará el IBEX mejor que el resto de las bolsas europeas? Respuesta 2, los países periféricos. O respuesta 3, Europa Core. Agradecer su participación en esta primera encuesta, agradecer también a los miembros de la Comunidad Financiera de Unience y a los miembros asociados de EFPA que han participado en esta misma encuesta durante la última semana y de las cuales compartiremos los resultados al final de las 3 presentaciones de esta mañana. Dejo paso ahora a nuestro CIO de renta fija global, Andrew Wells. Andrew, please, if you can share your thoughts on fixed income. Thank you.
Thank you. Good morning. No more tricky
Gracias. Buenos días.
questions.
Ya no van a tener que contestar más preguntas, así que de momento se pueden relajar. Quiero darle las gracias a todos por estar aquí esta mañana. El 2012 ha sido uno de los años para la inversión más volátiles y más interesantes. Y el final del año es un buen momento para evaluar lo que ha sucedido en este último año y hacer una previsión para el 2013. Con lo que me gustaría hacer es dedicar un rato a hablar sobre la situación macro para el 2013 desde el punto de vista global. Me centraré sobre todo en previsiones de inflación, tipos de interés, riesgo soberano e intentaré elaborar unas conclusiones de potencialmente qué es lo que puede suceder en el 2013. Hablaré de crédito, de high yield, de las oportunidades que puede haber ahí dentro del contexto del año pasado. Y después unas conclusiones desde el punto de vista macroeconómico con respecto a algunas de las estrategias de inversión y de fondos que nosotros creemos pueden aportar valor en el 2013. Pero probablemente lo mejor sería durante un momento recordar el 2012.
Kind introduction. I've been with Fidelity now for 17 years, and most of that time has been spent as a fund manager within fixed income. And if you'd said to me back in many of those years that we would have had returns of over 25% in a fixed income asset class, I would have looked at you and thought you were mad. There have been some incredible returns, but most importantly, if you forget about the returns for a moment and think about the investment environment and think about the uncertainty, the volatility, and the fundamental problems with debt that we've had globally, whether it's been the fiscal cliff, whether it's been the debt ceiling in the US, problems in Europe, issuance in Japan, etc., all these returns have been positive. And it's important to focus on that there has been a very, very positive investment experience. And in fixed income generally, it is a bit of a zero-sum game. You tend to get back your principal and your coupon, and if you get it back early through capital appreciation, there is a danger you'll have a negative experience at some stage in the future. So I think it's important that people bear that in mind. There is a reality about fixed income that people need to appreciate. The other thing to note from here is there's quite a nice ordinal slope of returns. The risky asset classes have done well. So high yield, emerging markets, clearly anything with credit comes next. Then you move down into governments, and at the very bottom, US Treasuries. It's no great surprise. Risk and return. It was a risk-on market. So one of the questions you've got to ask yourself for 2013 is simply, is it a risk-on market? Because simply returns will potentially follow the same pattern if it's a risk-on market, with a few exceptions, and we'd like to come to those later. So turning for a moment to the macro environment, what we tend to do when we think around the economic world is we look at the economic statistics and we build a range of surprise indices. How does the data actually come out compared to the expectation? Because that's very important. When you're looking at how markets move, it's how people are surprised by the outcome of data. And what we've seen at the back end of 2012 are positive surprises. We've seen positive growth coming out of China. We've seen more positive economic data coming out of the US. And we've seen clearly disappointing data coming out of Europe. And it's really this polarization that we're seeing at the moment. There is a danger that particularly in the US at the moment, there could be a rolling over of some of the data, and some of the stronger growth that we've seen in 2012 won't be continued in 2013. And I think there'll be a lot of focus on that in the coming year. The leading indicators, and particularly the money supply indicators, which I'll come to later, look to be concerning. And the velocity of money around the economy is very, very important. We've seen in Japan it's got very slow. The danger is in the US that all of this quantitative easing and pump priming that's going on is all well and good, but you need people to be borrowing, spending, consumers need to be out there spending, and it's worth bearing that in mind for later. Sorry, few. The biggest drag that we've got in the global economy at the moment is clearly the debt burdens across the world. Two examples here. US debt as a percentage of GDP, that rising through the 90s, through the 2000s, it's still up there. The only way, clearly, it's sustainable is the very low rates of interest, and it's being addressed slowly. But as it's addressed both in Europe and in the US, it's going to cause a drag on growth. And in the UK, you can see non-bank financial companies, actually, debt's been stable for the last 4 or 5 years. The explosion has been really in UK government debt, and that is symptomatic of government debt around the world. The problem has been transferred from corporates, from individuals to governments. That process of transfer is still ongoing and needs to be solved. Turning to the US for a moment. And particularly, there are some encouraging signs at the back end of 2012. The biggest concern was that we were going to see a similar slowdown with the fiscal cliff at the back end of the year. We had a similar problem back in September and October, and it caused a slowdown in capital spending in the US. What's interesting in the retail spending at the back end of 2012, it was much more positive. It appears that consumers are less worried and they feel that the government will continually muddle through these problems. So when it gets to the debt ceiling issue in March, April of 2013, there's less concern about that. And we've started to see a pickup in retail spending. We've started to see a pickup in employment. We've started to see a general pickup in housing activity. All of those are very positive for the global economy. What's less positive is the quality of employment. There is no wage inflation at the moment in the US. So it's broadly positive in the sense that interest rates will remain lower for longer. Inflation is clearly a bad thing. However, we do need to see GDP growth to pick up so that the US can actually be the push or the pull for other economies around the world. And at the moment, we haven't seen that level of GDP pickup happening in the US. The concern, as most of you know, and I hope that this is an honest explanation of what we're seeing at the moment. It's always very hard coming to an area where clearly there are significant problems. And what we're seeing, particularly here in Spain, we're seeing in Southern Europe, you're all aware of it more than anyone else, are the problems of unemployment and long-term unemployment. There has been a slowdown in the increase of unemployment, but unemployment is still increasing. And that's a very big concern. I, for one, in the experience that we've had, see the consumer as clearly the key driver of economic growth globally. The US consumer has been the core driver over very many years. Clearly, we'd like to think Asian consumers, the Chinese growth will be a great driver for global growth in the future. But there's no doubt on a domestic basis, we have to have, if not full employment, reasonable employment. And there's still no sign in Southern Europe that there is a return to a robust employment market. That has to be the major priority for 2013. We're seeing a contraction clearly in the Purchasing Managers' Index. Economic activity is slowing down, and we would expect a recession in aggregate Europe for 2013. Clearly, that's negative. It's positive for fixed income markets. We will have an underpinning of low interest rates through 2013. So from an investment standpoint, there's still opportunity for people to exploit that for some time to come. The last graph on the bottom right is perhaps one of the most concerning, and that's the historic real GDP growth per annum. You can see there that the blue bars are up to December 11 and the red bars up to December 12. And we've seen across the board a GDP contraction, negative GDP in peripheral Europe, and in core Europe, a significant slowdown. There are a number of comments in the press recently around it's very, very important that Germany in particular invests for growth and are not comfortable with a low GDP rate. They need to invest to help the pan-European economy, and they need to be encouraged to grow aggressively. The bright spot, as a global company, we have a large business in Asia. We sell funds in Asia, we invest in Asian companies, we have a lot of interaction. And I think that there is a significant chance that the Chinese growth will surprise on the upside in 2013. A lot of people talked about a hard landing for China in 2011, 2012. And what we've seen clearly is a lot of stimulus. A lot of economic activity, a pickup in borrowing and lending in China, both through the official and unofficial channels. And there is a possibility that we could see a GDP growth figure of 8% for China in 2013. That would be very positive for global growth. It would be positive for the Asian economic region. Asia as a whole now is the biggest economic region in the world. It's bigger than the US, it's bigger than Europe in aggregate. And clearly, a lot of people have talked about the Chinese consumer. Chinese consumer activity is picking up. But regionally, Pan-Asia is looking very interesting for 2013. And I think it will surprise on the upside. So on a macro perspective, signs of better growth, slow growth in the US, much stronger growth potentially in emerging markets and China in particular, and Europe still under a cloud with some problems relating to its debt at the moment and unemployment. And we'll come to that a bit more. One of the biggest concerns with all of the central bank activity at the moment is that of inflation. And I know that many people, clearly inflation is not a burning issue in their minds. I thought it was interesting that if you looked at the series of returns on that first slide, global inflation products actually ranked in the middle of the pack in terms of returns for 2012. I think the figure was between 7 to 8%, even though there is no inflation anywhere in the world. All of the quantitative easing that we've had the increase in central bank activity and the balance sheets getting larger has been there to try and obviously spur economic growth. Each time we get an injection, QE1, QE2, Operation Twist in the US, we've seen a change in the break-even rates of inflation, how we measure inflation. But what we haven't seen is a real pickup in consumer expenditure. The graph on the left-hand slide shows basically how much personal consumption expenditure changes after each of the QE or Operation Twist activities. And actually, there has been some activity. With each one, it's got slightly better, but it's not inflationary. And I think the biggest change in this, and one of the most important aspects that we're seeing globally, is the blue line on the graph on the right-hand side. The scale for that is on the bottom, from 1980 to 2010. What we've seen is the velocity of money in the Japanese market, the blue line, over the past 30 years has got slower and slower and slower. People aren't spending. They're saving, they're being very, very cautious. And interestingly, the red line, which is the top axis, is the US from 95 up until the present day, and then clearly what's going to happen until 2025. And it's mirrored that Japanese slowdown. Basically, the velocity of money, so the more that the Fed pumps into the economy, then people are actually, they're not borrowing, they're not spending, banks aren't lending, and that's what's causing the stagnation. Now, I think that will pick up, but the danger is in the US that with the amount of money that's out there in the economy, when it does pick up, the inflationary impact will be very, very significant. And so investors need to think very carefully. It may not be attractive at the moment to think about investing in inflation assets, but at the back end of 2013, it could be a very, very sensible thing to have done. So I think people need to think about what their inflation strategy is, because it will be an end result of the activity that's taking place at the moment. Inevitably, central banks will overshoot. Part of this process of the re-leveraging of governments in particular is causing a fundamental shift in credit quality. So if you look in the US, the Euro area, the UK or Japan, this gross government debt to GDP, clearly there's a greater amount and by the end of 2015, Spanish debt to GDP will probably be around 100%, given the current path of issuance. And clearly, the government deficit as a percentage of GDP is clearly getting greater as well. That's inevitably going to lead to further government downgrades. And of course, the ironic thing of that is that at the same time governments are potentially getting downgraded, the price of their debt is going up and the yield is clearly getting lower. So when we look at the fair value models that we have for developed market government debt, all of them are far too expensive at the moment. So in the US, on the 10-year, we would expect for the current economic climate, the 10-year to be 1.25% higher. In the UK, we'd expect it to be 1% higher, and in Europe, around 70 basis points higher. The reason you all know that they're this low, the yields, the prices are high, is because that rush of safe haven assets that we've seen. And if we get a solution to the economic problems, that will be corrected, and we will see a significant correction. So I would urge people very, very carefully to look at their holdings of government securities in particular. Now, there will be a very destructive piece of price action that takes place at some stage, because that will correct, and potentially it will overshoot. And clearly, because of the long-dated nature of some of the government exposures, a 1% shift in a parallel shift in the yield curve on a 10-year bond is very destructive towards the overall capital value. And I think people have seen government debt in a very good light, developed markets lately, particularly the high-quality end, and I urge them to look at what their exposure is and rebalance their holdings. It would be wrong of me not to come to Madrid and not speak particularly around our views on Spanish government debt. And, clearly, I think that, the amazing thing on that first slide was the total return of Spanish government debt in aggregate in 2012, 6%. My God, it's been one of the most nerve-wracking 6% you could ever have experienced. The volatility to get from the beginning of the year to the end of the year and a 6% return has been all over the place. And that's the concern, that government debt in particular shouldn't be that kind of volatile ride. For investors, it should be a safe haven, it should be security, you should have security of principal and interest, and it should be something that our investors can rely upon. So we actually have been broadly positive up until very recently on the relative value of Spanish government debt. As it's become more expensive and tighter, I think it probably fairly reflects the economic problems that exist and the volatility that we'll see. There's a lot of issuance to be done in 2013. We're clearly going to have more political volatility, and I think you have to be very cautious around the holdings. I would expect there to be full repayment of principal and interest, but I would also expect there to be opportunities to buy it more cheaply in the future as well, because markets will be volatile. And so I would be very cautious around the amount that you have and clearly the volatility over 2013. We happen to be in a very, very benign environment at the moment. The measure of volatility, the VIX that people use, is very, very low. It will pick up. I know Stephen will talk around volatility in his presentation. And it's inevitable that as an asset manager, as an investor, there will be opportunities to buy it cheaper in the future as well. So in summary, I would be very concerned around inflation. I think there's a significant tail risk that's out there. Developed market sovereign credit quality is deteriorating. And if it's deteriorating and we have a potential return to kind of normality at some stage in 2013-14, I'd be very cautious around government bond holdings. And Spanish government debt is supported by a very accommodative ECB. There is a backstop facility that's out there in terms of the open market operations and the ability of the ECB to buy debt if they are requested to do so. That is the underpinning at the moment of the current prices. But it will still be a volatile ride, I think, in the intervening time. Turning to credit for a moment, what I would say is that credit fundamentals are very strong. So most credit investing, particularly investment grade, companies have restructured many of their debt profiles. They've used the opportunity to issue in a very low interest rate environment. And it's very positive for investors, for high quality companies at the moment, to invest in good quality investment grade credits. Telefonica is a very good example of a company whereby the management really do get it. We spend a lot of time speaking to companies and companies like Telefonica where they understand that their credit rating is very, very important. They've gone through a process of cutting their dividend, of making sure they're selling assets, of making sure they have a robust business plan to maintain a good credit quality so that they can issue debt, refinance, and run their company in a sophisticated fashion. That kind of approach is very, very positive and is much more encouraging. I would be a significant buyer of a company that runs their debt profile well, rather than one that has an open-ended liability. In terms of spreads, generally, on the top there you can see global high yield. The yield looks low. We're in a yield-hungry environment across the world. However, on the bottom slide below it, you can see the spread relative to governments is still actually relatively attractive. And while government yields remain very, very low, we will see a continued push into high yield. There will inevitably be some rotation. Investors have done very well. What we're seeing as a company is that those people who were in early are tending to rotate into other asset classes. But we see a significant demand for high yield products globally. In terms of investment grade credit, it's a similar story. the yields on the face of it look low, but if we're in a low-growth environment for longer, potentially what we will see is spread compression will go even further in corporates. So I would be very constructive around high-quality corporate bonds. The important thing in high yield, particularly if you look in the European arena, is if you're in a GDP contraction environment, there will be some companies in high yield that do not do well. It is not a beta play. It's around name selection and credit selection. You need to be at the higher quality end of high yield, and you need to look at the companies very, very closely if you're in a GDP contraction environment. It's different if GDP is growing. Basically, everything gets lifted. It's a very, very benign environment. In terms of European non-financial spreads to bunds, I mentioned a company like Telefonica. We see opportunities. We see opportunities where managements are running their balance sheet well, where they have a strong business. And there is diversity that still exists that's out there. When we look at the spread dispersion, we take the bottom and top 10% away and look at the spread of bonds that are in the mainstream in the index. And we continue to see opportunities as an investment house to get people diversified pools of assets. And that's quite encouraging going forward. There is a sign of releveraging in credit, and this is something that you have to be concerned about because it depends why there's a releveraging going on. I know Matt will speak later on clearly around European companies. If the releveraging is a positive in terms of running the business, in growing new assets, growing new businesses, it's incrementally positive, then as a fixed income investor, we can probably take that. What we don't like is leverage in companies that increases dividend flows or is actually reducing the credit profile. So leverage is potentially destructive for the credit profiles, but I wouldn't be too concerned about the amount of it at the moment. Companies are fairly cautious, and they're mostly sitting on, very, very global companies in particular, large amounts of cash. In terms of high yield, high yield has been a phenomenal asset class for many years. I actually like it strategically as an asset class, and I would encourage you as investors, even at this level, to take a close look at not just European high yield, but global high yield and some of the other areas like Asian high yield. I ran and developed our Asian high yield business in the mid-2000s. The great thing about high yield is if you can diversify and you can get a coupon of anywhere between 6, 8, 10%, it is a very, very good contributor to total return that's consistent, and it smooths the volatility. And so over the long term, that part of the capital structure of a company where you're getting a very good and consistent income stream provides a good total return series. And those people who are not looking at high yield or who haven't looked at the asset class should think about it very carefully. Name selection is very important, avoiding defaults is very important, and diversity clearly comes into it. We don't think this pessimistic forecast will take place. Companies can refinance themselves very well at the moment. And so I would look for high yield actually to be quite an attractive asset class in 2013. Even if interest rates start to move up, which I don't think they will do aggressively, they will move up because we're in a stronger economic environment and there's still some room for some spread compression in the asset class. I'm going to leave emerging markets because clearly Steve's got a presentation, but what I would say is that if you're in the camp that things are improving, the next leg of emerging markets will be very positive in emerging market currencies. And I think that there's a lot of value to be had in currency appreciation. We started a Chinese bond fund a couple of years ago, and the way in which that fund has appreciated in a very orderly fashion, primarily because of the currency appreciation and the managed appreciation, has been a really interesting asset class to look at. There are some great opportunities out in Asia at the moment, and I encourage you to do that. So in summary, credit fundamentals are strong. Early signs of releveraging is something to be wary of, and low levels of default are out there. It's broadly positive in credit, and I would remain positive in credit for 2013. What I'm going to do is kind of skip the conclusions. I think I've mentioned most of those points. I would urge you to think about inflation in terms of how you invest. What tends to happen with inflation is it comes, the asset class is technically very, very tight, and the assets will gap up higher. It will be too late to start thinking about it at the back end of 2013. So even if you're interested in buying a fund or a strategy, know what you would do if you were to invest in the asset class, which is very, very important. And finally, I've put a slide up here. We haven't really done in the past, but I thought it was quite interesting to do. There's three basic scenarios. Number one, which is our base case. I would put a 70 to 80% chance of the base case happening. So low growth, low inflation, and this continuing muddling through of the political problems that we have in Europe, the issues in the US. And in that case, the asset classes that will do best will be inevitably in a low interest rate environment, high yield, companies can refinance, emerging markets will continue to grow more aggressively, higher GDP growth, we'll see some inflation coming through. If you're in the camp that's a tail risk environment, whereby actually much better macro conditions, you think we can get through this much quicker, then clearly shorter duration assets are very important. Duration will move. Government bonds are not the place to be, and some of the emerging markets and credit areas, pure credit, short duration is where you should be, and we've put some of the funds there on the right-hand side that we think would benefit in that environment. And then if you're in that kind of 10 to 15% camp that actually things are going to get a lot worse, then, it really is. Government bonds, high quality, will probably perform well. They'll continue to do well. We've seen a big move recently to strategic bond funds and funds that have a real mix of asset classes where the asset manager moves more aggressively. So strategic bond funds in Fidelity mean a mix of government bonds, nominals, real bonds, the inflation government bonds, credit bonds, and then high yield and emerging markets, and the asset manager moving between those different classes. You tend to get lower income, but you get protection. You get protection from inflation and from the government bonds, and you get credit participation. And it's an asset class that says we don't quite know where it's going, but actually that mix of investments will give us more stability and security and some participation in the upside. And I think we will increasingly see people turn to those strategic funds that have a bigger mix of assets, and also where the index or the reference point is not on the issuance. It's important that people shouldn't be investing just because there's a lot of something, particularly in debt, because clearly when there's a lot of something, it means someone's in trouble and they need to borrow a lot. So that's not the place to put your money, or at least the majority of it. So with that, I'll leave it there. I'll look forward to your questions later, and I'll hand over to Steve, who's going to talk around emerging markets. Thank you.
Thanks, Andrew. Well, thanks very much. It's a real pleasure to be here this morning to talk to you all about emerging market debt. So what I'm going to do, I'm going to split the presentation into three different sections. So in the first section, I'm going to look at the EM debt universe in a historical context and really speaks about some of the main characteristics of that market at the moment. Then I'm going to look at some of the main sources of alpha in EM debt and give you some assessment, really, of what we're looking for this year, some kind of some idea of what you can expect for total returns. And then the third and final section, I'm going to look at some of the risks for this year. It was obviously a very good year for EM debt last year, but clearly, with spreads so tight, we just want to really assess some of the risks. So let's turn to the first section. So this slide here is a very interesting chart, and it shows the evolution of the debt asset class over the last few years. And you can see that it really started off with Brady debt back in the late 1980s, early 1990s. That evolved into hard currency debt market, which then evolved as term structures of interest rates went lower and lower. The local debt market began to rise. And then, as you can see, we've now got the formation of a large EM corporate debt market. Now, over this time, obviously, there's been a fair share of crises in emerging markets. And really, when you look at those crises, I think they've really been broadly split into three different categories. The first one is a banking crisis, such as Turkey at the start of 2001. We had the Asian crisis, which was a balance of payments crisis in 1997. And we also had a solvency crisis in Argentina in 2001. So they're the three main types of crises. And I think the reason why I mention this is that I think those crises in themselves really, shaped the formation of EM right now. These countries went through, they had their imbalances, which they've eradicated over time because of these crises in the past. And it really set the stage for, the private sector deleveraging, public sector deleveraging in the EM, and the vast buildup of FX reserves left these countries in a much better shape than the developed market countries when we entered the Great Recession in 2007. So as a result, we've seen a real unprecedented re-rating of emerging market debt in the last few years. When you look at EM versus DM, that rating convergence has been phenomenal. And so no longer are the imbalances in the emerging markets. Those public sector and private sector imbalances have transferred to the developed markets, which have been plagued by the threat of deflation and over-leveraged private sector and so on. Now, I'm not saying that emerging markets is the new safe haven here, but there are likely to be risks in EM over the next few years or so, as I'll talk about in a few minutes. But I do think right now that emerging markets does offer the diversification benefits for investors seeking yield, but also I think you get to move away from the imbalances in the DM markets and go into the more the better balanced countries in emerging markets. And as you can see from this slide, EM is still very attractive to developed markets on a risk-adjusted basis. When you look at local currency yields, for instance, they offer a pickup of 4% over in relative basis versus developed market core yields, and 2.5% on a real basis. So there is some value still. Now, there's many positive reasons to invest in emerging markets, which is why I think it's been such a strong performing asset class in an absolute and risk-adjusted basis in the past decade. And I think, it's been certainly a beneficiary of the search for yield amongst investors and a way to get away from the debt-laden developed markets. And also, when you think about it, the emerging market debt universe is actually quite small in relation to the developed market debt market. And I think over time you should see the structural reallocation away from the developed markets towards the EM. So just to give you some numbers, for instance, the total size of the emerging market debt universe is around $8 trillion. Now, about $2.5 trillion of that is actually linked to is benchmarked against the JP Morgan indices. Now, a lot of debt within that universe doesn't appear in the free float. A large part just gets swallowed up by local insurance pension funds and so on. So it doesn't really see the light of day. But when you look at the size of the EM debt universe in aggregate, it's now approaching the same size as the US high-yield market. But the actual amount of marketable debt is about 15% of the whole debt universe, the whole global debt universe. Just 15% is EM, which is obviously a low weighting. When you compare it to its GDP, it's actually quite low weighting. Now, of that 15% in emerging markets, about 3% is hard currency debt, and the other 12% is local currency debt. So I think, when you look at it, I think that you could see this asset reallocation over time as people move further and further away from the core and get towards emerging markets. And you think back to 2008. I remember an IMF report, for instance, in 2008 that suggested just a 1% shift in asset allocation away from the core to the emerging markets is equivalent to about $45 billion in inflows into the EM universe. It's a huge impact. It's you know, when you look at it this year, we had about $36 billion of inflows into dedicated EM. Now, this 1% shift can cause $45 billion, so it can have a very profound impact if you see this asset allocation towards EM over the next few years. So I think, you know, going forward, I think the trend is still going to be one where you see those flows going towards the emerging markets. Now, the big development over the past few years in emerging market debt has been really the formation of a local currency market and the trend towards more issuance of local currency debt. And when you look at it now, if you look at sovereign issuance split between hard currency and local currency, about 87% of government issuance is in the form of local currency. Now, I think this makes sense. Obviously, in the dark old days of emerging markets, you know, issuing hard currency debt made sense. The investors would not bear the currency risk. The FX risk was borne by governments. Now, as term structure of interest rates have fallen, as inflation pressures have moderated and local interest rates have fallen, it's made more sense for that FX risk to be borne by investors. So there's been more of a trend towards local currency risk over the last few years. Now, I think the other interesting thing about the local currency market, and it's one thing which really shouldn't be underestimated, is the influence of local pension funds and insurance companies. So when you look at pension funds, for instance, they have around about $1.7 trillion of assets under management in these local markets, and insurance companies have about $2.7 trillion. So there's always a huge natural bid for domestic local currency bonds in these markets. It's not just as that market develops and develops, as the middle classes grow in EM, you're going to see more of a natural bid. So I think that reduces a lot of the volatility and keeps assets onshore. So I think it's that is another huge influence on these local currency bond markets. The other change has been this growth in the size of the EM corporate bond market, which is really seen as like kind of the last frontier for emerging market investors, those particularly looking for yield. You see from this chart, it's a very interesting chart actually, about 70% of the new issue market in the external debt this year has come from corporate issuance. 70%, so that's up from 20%. Corporates only accounted for about 20% of hard currency issuance a decade ago, and now it's 70%. And the interesting thing about this year, I think, and one of the reasons why EM external debt is done particularly well, is that when you look at the supply and demand, it's just been a phenomenal technical bid for EM hard currency sovereigns. And the reason why is because when you look at net issuance of EM external debt this year, it's been about $10 billion, just $10 billion. And this is an asset class which has had huge inflows. And so the natural recipient, in a market where it's hardly grown at all, the natural recipients of those inflows into hard currency funds has been into EM corporates, where there has been about $350 billion of net issuance. So that's why the corporate bond market has been, has been so big this year, is because the flows have really gone to EM corporates. Now, the total outstanding amount of EM corporate debt is about $2.9 trillion, and about 66% of this amount is actually held in local currency corporate debt. But again, this never really sees the light of day. A large part of the EM corporate debt denominated in local currency is actually in, say, the likes of India and China. It gets bought up by local asset managers and pension funds, insurance companies, and it never sees the light of day. It just matures. So it's still not a very developed market, although as time goes by, I think that market will become more and more interesting, and it's certainly a market which we're getting involved in. But if you take the JP Morgan SEMBI, for instance, this is the corporate, it's a hard currency index for emerging market corporates. It's grown rapidly since 2008, which is when that index was launched. It has about $42 billion in assets under management benchmarked against this series, and the SEMBI Broad, so the broader index for hard currency corporates, is actually now surpassed the MB Global. So the corporate EM corporate market is now bigger in size than the sovereign EM hard currency index. So it's $482 billion in the CMB Broad, and it's $468 billion in the MB Global. Now, when you look at the EM corporate market, of this CMB index, about 72% of this index is investment grade. So it's a very highly rated index. 28% is high yield. It's rated BBB+. And the blended yield on the CMB at the moment is 4.9%. So it's about 340 basis points pickup over US Treasury. So it's been a very attractive market for investors who have been wanting to get EM, who wanted EM exposure, worried about the local currency debt because of FX volatility. So the natural, the default has been to put it into the hard currency, and that because the EM corporate market has been one place where you can park those funds, and it's still attractive in spread terms and so on. It's been a great market, and I think that will continue to be a good market, actually, as we'll see in a bit later. So now we'll come to a slightly more interesting part, which I think is really looking at some of the sources of alpha in EM. And I think, the important thing here to note, and why we've had such good performance, it's not just been an indiscriminate search field. It's a terrible phrase, but I think this has been largely because of the re-rating of the EM asset class over the last few years relative to developed markets. And if you turn in the appendix of your pack, you can see there's a lovely chart which shows how the two have converged in terms of the ratings between EM and DM. But if you look at the MB, this is the hard currency index, about 63% of that index is investment grade, and the average rating is BBB. But the interesting thing is that even in the midst of the financial crisis, you actually saw EM sovereigns continue to be upgraded on a net basis, whereas whereas developed markets, I think the number is, it experienced about 100 downgrades across the board between 2008 and 2011. So there's been the convergence between the ratings has been, I think, one reason why EM has been so popular. And you look at the fundamentals in emerging markets. The public sector debt to GDP in EM is 34%, whereas in developed markets it's 114%. And when you look at fiscal deficits, the fiscal deficit in EM is 2.2% of GDP, whereas in developed markets it's 6.2%. So there's no surprise you've seen this fundamental re-rating. And I think when you look at this chart, you can see why EM has performed so well. And in fact, EM external debt has been the best performing asset class of the last 18 years or so, both on an absolute but also on a risk-adjusted basis. So when you take volatility into consideration, you can still look at, if you look at the Sharpe ratio, it's been very, very strong for EM. So EM sovereign is just behind European high-grade credit, but in absolute terms, EM credit has delivered 600% returns in just under 20 years. And the great thing is, it's actually, if you say it quietly, it's actually beat EM equities as well. So even on an absolute and risk-adjusted basis, this is an asset class which has beat EM equities. So, when you look at local currency debt and EM currencies, they've also performed very well as well. But you can see from the Sharpe ratios that they're slightly lower down the scale because FX volatility has obviously detracted from the Sharpe ratios because the volatility has been quite high in many years. So as we've seen, there's actually still quite a low structural weight of emerging market debt in asset managers' portfolios, and I think over time this is going to increase. And in fact, when you look at it, the low core interest rate environment at the moment, and particularly when you look at what the Fed is doing, and I think this is one of the reasons why credit is performing so well. The Fed are basically they are creating a dearth, a complete lack of supply of credit products in its monthly purchase of MBS. It purchases $40 billion a month. That's almost $500 billion a year of purchases of credit in MBS, and also its treasury purchase as well. But basically, it's forced investors down the credit chain to look for other, for other credit products. And I think that's one of the reasons why EM has performed so well and why we've seen such huge inflows, is because it's a safer asset, it's a decent asset class where you are diversifying your balance sheet risks. So when you look at the inflows into emerging market funds this year, just this year alone, we had about $36 billion of inflows into dedicated EM funds. That's just dedicated. Then you add on top strategic inflows, so it's things like crossover money, and also Japanese retail and institutional money, which came into emerging markets. So all in all, this year, EM was a recipient of about $85 billion of inflows. Now, like I said, a large part went in of these inflows, as you can see from the chart on the right-hand side here. A large part of those inflows defaulted into hard currency because investors in the previous year, in 2011, saw quite rapid, quite high FX volatility, and that really deterred them from wanting to gain exposure through local currency funds. So that money went into hard currency funds. And the reason why we had the volatility in 2011 was that we saw a very sizable downshift in EM PMIs. The PMIs fell very sharply towards the end of the year. So currencies, as Andrew showed in that chart, I'll show you in a minute, there's this chart, but you saw currency performance detract quite sharply from local currency funds. So this year we've seen the funds going into EM hard currency as a result. And I think when I look at it for next year, I do think that this trend towards hard currency defaulting might actually change. And when, like I say, the issuance this year has been one of the main reasons, or the lack of issuance has been one reason why we've seen the external debt markets trading so well. And so, I think, when I look into next year, if I show you this chart on the next page, you can see the question is, where do we go from here? And I think, certainly at Fidelity, we look at emerging markets in a very holistic way. We look at the best way, the most optimal way of allocating our funds to our EM different asset classes. So Alpha is portable. We want to ask the question, what's going to work best in 2013? Is it going to be hard currency? Is it going to be local duration? Or is it going to be local FX? And when I look back to last year, the alpha really in EM came from two different sources. The first one was local duration. So with treasury yields falling, and you saw this continued appetite for yield, and you saw money going into local duration bonds, but also it went into EM credit with this huge appetite, this search for yield. But I think this year it really could come from local currency funds. Local debt, I think, is the more attractive asset class on a risk-adjusted basis. And the reason being, as you can see from this chart, well, both charts actually, you can see there's a very high correlation between PMIs and currency returns. So what we're seeing at the moment is the beginnings of an improvement in EM PMIs. We're seeing China PMI moving higher. We're seeing right across the board, the momentum in the PMIs is picking up right across the EM universe, almost without exception. And as a result, if that continues to occur, then we're likely to see EM currencies performing much better for next year. So I do think when I look at I know it's one of the questions which you've all been asked about, what you think is the best performing asset class for this year. When I think about it in my mind, I look at it in this way. I would say that local FX is going to be one of the better asset classes, followed by, I think, inflation-linked bonds in EM, then credit, and then I'd say local duration. I think we could see treasury yields moving higher, in which case local duration bonds will probably be less attractive. So I think there's some. I think local debt is going to be one of the more attractive assets markets for next year. That's it. So let's turn to the issue of potential returns. And as you can see from this chart, it's an interesting chart. You can see that spreads are pretty close to the 2007 tights here in hard currency debt. Although for local currency debt, the extent of spread compression has probably been a little bit less in recent years. I think there's two reasons for that. The first one is that inflation pressures persist with output gaps still quite tight, food prices pushing through into headline inflation. And so, inflation expectations have been slightly higher in EM. And the second one, of course, is the volatility of FX has been quite high, and that's been embedded as a risk premium in local currency yields. So I think for sure appetite for yield is going to remain in place in EM, especially as investors are pushed down the credit spectrum. But I think there are a few risks on the horizon which you have to be very cognizant about. It's not going to be a straight line. Last year returns were exceptionally high, but I think there are some things which we have to look out for. If I gave tried to give you a figure as to what I expected for EM returns next year, I think it's quite hard to do in local currency debt, but in hard currency debt, I think it's a little bit easier. And what I've done on page 23, on the appendix at the back of the pack you have, you can see some of the calculations that we've made to work out just what our total returns for EM hard currency will be this year. But in a nutshell, I've got three different scenarios: a bear case, a bull case, and a base case, very similar to what Andrew showed, and each with a probability attached. And so if you make an assumption about loan defaults, for instance, the bear case, we'd expect defaults to rise by about 2% in EM sovereigns, and that would make a negative contribution to returns. We also make an assumption on spreads, and so we're expecting spreads to tighten just very narrowly this year by about another 20 or 30 basis points or so. And also we make an assumption on treasury yields, and we do think treasury yields could move marginally higher this year. It's very difficult to know exactly how much, but when we plug the numbers into our expected return calculator, we're expecting EM hard currency returns this year to be somewhere in the order of 6%. So when you look at it last year, the hard currency returns were about 18%. So I think it's going to be still a decent 2013 for hard currency, but it's going to be nowhere near as good as last year. So where can things trip us up? And I think there's a few. The first one, I'll go through the sort of more benign ones first. The first one really is heavy refinancing risks in 2014. It's not really on people's radar screens at the moment, but it will be as we get towards the end of the year. So if you look at the chart, for instance, on this page, you can see that the quarterly refinancing schedules for sovereigns, which is the blue bars, is around about $30 billion each quarter. But then suddenly in 2014, you get this big pickup in refinancing needs. And at the moment, if the benign environment or this search for yield continues, that wouldn't seem like a difficult obstacle for EM investors. But if you do get a more difficult environment for EM, that refinancing risk could really become quite a worry for EM investors in the second half of this year. The second risk is the unintended consequences of QE, and as Andrew said, I totally agree. I think it's one of the things about QE is that it's quite dormant. The effects are quite dormant at the moment, but as the velocity of circulation of money eventually does pick up, that's going to be quite toxic in many ways for developed markets. If we look at EM, the unintended consequences I think is more proximate, it's more immediate right now, in that these central banks are already engaging in currency wars. They're deliberately keeping interest rates probably lower than they should be to prevent currencies from appreciating too rapidly. And they're still erring on the side of caution by keeping rates too low, even when their output gaps are quite tight. Korea is a very good example of that. So it's engendering inflation expectations already in EM. So I think break-even inflation is a great trade to have on in places like Turkey and Brazil right now. So the unintended consequences of QE are already here in emerging markets. Now, I think the other risk as well is that you start seeing treasury yields moving higher, and in the event that treasury yields moving higher, obviously your total returns, your duration risk is going to be affected in EM hard currency sovereign debt. And so we have to find ways of doing that. You can either go for more high-yielding, lower duration assets, so high OAS instruments, or you can hedge out some of your treasury risk. But I think the point I'm trying to make here is that if you start seeing treasury yields moving higher and total returns in EM hard currency debt beginning to turn negative, we could see investors begin to get quite worried about that and start pulling money. The huge inflows that came in last year could begin to trickle out. I also think that the things like default risks in EM are very low. If we do see this the bear case that Andrew pointed out, where you start seeing growth slide, then you could see that begin to rise, the defaults begin to rise. So when you look at the default rate in EM in 2008, 2009, the default rate was actually quite low. It just hit a peak of only 2%, whereas EM corporate credit in the crisis, EM corporate default rate was actually about 14%. So it's still way below the corporate, the default rates that we experienced during the 2001-2002 recession. So right now, the sovereign default rate in EM is actually very low. But if we do get the bear case coming through of growth sliding quite precipitously, then that could be one reason why we start seeing, this, at the moment, default rate in EM sovereigns is about 1%, and that could begin to rise as well. And that could begin to worry investors. Now, the other one as well is volatility, and Andrew mentioned the VIX. I look back to last year, to the beginning of last year, and investors had many, like a shopping list of worries. Worries about hard landing in China, worries about the fiscal cliff, worried about an implosion in the Eurozone. And each hurdle went by, and those risks dropped off the scale. And as a result, we saw the VIX continue to go lower and lower and lower. And not just the VIX, but other measures of volatility as well across all different asset classes. And so when I look at this year, there's a very sort of benign view on the world. All the risks, the tail risks have gone. We've now got plain sailing, just a very anemic growth of around about 2%, probably about 4.5% in EM. And so the risks seem to have disappeared. But I think the reason why the VIX is so low and volatility is so low is twofold. First of all, because the disparity in views of growth have just been converging and converging. So as before, there's a very tight relationship between the disparity of growth. So if people have varying expectations of growth, the VIX tends to go higher. There's a lot more uncertainty about the growth trajectory. But right now, everybody's now just going on this very straight and narrow path of expecting benign growth. And if we start seeing that, if we see growth go one way or the other, in other words, we have a very sharp pickup in growth, or we get a sharp fall in growth, VIX is going to pick up. And the second reason is why vol is so low is because every time it's very expensive to buy option premium in vol. And so with this whole appetite for yield, it's an expensive strategy to keep buying vol. So I look at vol. I think this year could be my base case this year is one where we see grow. The returns in EM continue to be fairly decent, somewhere in the order of 6%. But we're going to have significant volatility around this year, similar to the case that Andrew mentioned for Spanish bonds, where the volatility of those returns throughout the year was extremely high. And this year is all about tail risk management, I think. We had a very strong year last year. The risk reward when you look at spreads is very tight right now. The risk reward is not so great. But I think we're going to have some great opportunities where we're certainly looking at tail risk management in our funds. And if we get some significant sell-off in EM, I think it's going to be for some great opportunities to buy. So I think that's it. So my conclusion really is that the EM asset class is in great shape. There are some risks on the horizon for this year, but I do think this is all about diversification and looking for different alpha sources. We're certainly looking for FX to perform better this year than say hard currency. So I think you should really focus on looking at, say, local debt funds, for instance. So that's it from me, and I think I now pass over to Matt.
Great, thanks very much, Steve. I have the pleasure of giving you the final presentation today. I'm going to be presenting European equities. So we've moved from one of the best performing asset classes of last decade to what must be one of the worst performing asset classes of last decade. So why do I get excited about investing in European equities over the next decade? Well, I think there are three key arguments that I want to explore today. And the presentation goes through these. And the first one is that the companies in Europe are in much better shape than the economies are. There's a big difference between European companies and European economies. It's a very key differentiation to make there. European companies have got some fantastic global franchises. Some of the leading brands on the globe are coming from Europe. 40% of the top 100 global brands are European businesses. Finally, European companies are very cheap. The result of a decade of poor performance is that European equity markets are very cheap compared to history, and future returns have shown a strong correlation with the starting valuation point. So you've got a combination of very strong companies, globally competitive positions, and attractive starting valuations. So let me explore each of these points in the rest of the presentation. So let's start off with the economic summary. I'm not going to pretend that the European economy is in fantastic shape. It clearly isn't. It requires major surgery. The actions of the ECB have been extremely helpful. I liken this to an anaesthetic. They have taken away the pain. Now can the politicians, can the countries actually execute on the surgery, the restructuring that's needed in order to regain competitiveness and for the European economies to grow again? And Europe does need growth. It's not just about austerity. Europe needs to return to growth in order to deliver the cash flow and pay back the sovereign debt, pay back all of the debts that have been built up. So how do we achieve this? Well, I think there are three options. Firstly, you can buy growth in the short term simply by increasing government spending. Obviously, this leaves you with a bigger problem down the road, and I suspect that some of our bond friends may not be best pleased with that option. Secondly, you can seek debt forgiveness. You can just default on your debts. You can exit the euro and devalue your currency, and suddenly you'll be a lot more competitive than France and Germany, and you'll be able to return to growth. Again, that causes a lot of volatility and pain in the short term. So again, I don't think that's the best option. So the third option, and to me the most attractive option, is to drive long-term growth by increasing the competitiveness of the economies. Now, that isn't a quick fix. That takes time. That takes very difficult decisions. And it will lead to ongoing macro volatility. But that is a process which I believe can be achieved and which has shown results in countries like Germany. So let's move forward and talk about why I care about competitiveness so much in this context. So this table shows the labour costs for a series of different countries across the globe. And I've ringed Germany up at the top, and then a series of peripheral countries further down. And what this shows is that the labour costs in US dollars for a manufacturing employee, and then on the right-hand side, it indexes all of these back to 100 for the US. So you can see how each country has done relative to the US on the far right-hand side of the graph. So you can see that Germany has always been more expensive than the US and has basically stayed a similar level more expensive than the US over the past 15 years. What's gone on in Southern Europe? Well, you can see that Ireland, for example, has gone from being roughly 30% cheaper than the US to manufacturing in to being 10% more expensive. So you've had roughly a 50% loss of competitiveness over that 15-year period. Similarly, in Italy, you've gone from being 14% cheaper to being slightly more expensive. In Spain, you've lost from being 40% cheaper to only being 20% cheaper. Each of these countries has lost competitiveness in manufacturing, in labour costs over the last 15 years. So why do we care about that? Well, this just shows the performance of unit labour costs and unemployment over the last 20 years. And it's a straight comparison between Germany and France. So to start with, through the 1990s, German labour costs rise more rapidly than French labour costs do. They lose competitiveness. And on the right-hand side, you can see that throughout the 1990s, German unemployment rates rise relative to those in France. Now, in 2003-2004, the German government puts through a series of labour market reforms that increase the flexibility of the economy and reduce labour costs, improve the competitiveness of the German economy. You can see that from that point onwards, unit labour costs start to fall quite sharply to start with in Germany, and soon after this point, German unemployment starts to turn round. For the first time in over a decade, they start to drive new job growth. Job growth accelerates, and what you see is a sharp fall in the unemployment rate compared to that in France. Competitiveness matters. And if what you have achieved in Germany can be achieved elsewhere, then we can also drive improved job growth through the rest of the European economy. So let's see what's been achieved in some of the peripheral countries over the past 3 years, because obviously you've been taking some very painful decisions in countries like Spain, like Italy, like Ireland. So you can see here the relative unit labour costs since the formation of the euro back in 1999. So you can see the competitiveness that Germany gained for the first decade as they kept a lid on wage inflation, whereas wage inflation rose rapidly in many of the southern European and Irish economies. And then you can see what's happened since 2009. The measures that have been taken have changed this pattern. So these economies in Spain, in Greece, in Ireland have all started to regain competitiveness. But you can see that there's still a long way to travel in order to get back to where we were 10 or 15 years ago. And remember that Germany has only maintained competitiveness in a global context against countries like the US, countries like Japan. So we still have further to travel on this road. But the positive news is, at least the direction of travel is, in the right way now. We are moving towards better competitiveness in these countries. The part where you don't see this yet is in Italy and France. You can see Italy in the red here and France in the yellow. So far, the measures that have been taken in these countries have not achieved this improvement in competitiveness, and these countries are clearly not out of the woods yet in terms of job growth and competitiveness in a global context. So let's look at this global context in a little bit more detail. And what this table shows is performance outside of Europe. So we've got production and durable goods orders in the US, which are, as you can see, back to prior peak levels, and global industrial production, where you can see it's actually well beyond the prior peak levels. So although the European economy has been weak over the past 3 or 4 years, that's not been the case for the global economy as a whole. The US has rebounded back to its peak. Emerging markets, as Steve has described, have been very strong, and total global production is well above prior peak levels. So this is positive for European companies. Remember, European companies are not just the European economy. Half of the revenues, the profits of European companies come from Europe, roughly a quarter from the US, and roughly a quarter from emerging markets. So these companies don't just depend on what happens to Europe. They depend on what happens to the global economy. And that is an important distinction to make. So what we've seen here is that you've seen a sharp decline in Europe, but we're not in the same situation as 2009. In 2009, the whole global economy had seen a pullback. We were at depressed levels of production in the entire global economy. That is not the case today. And it is important to make that distinction when you're thinking about investing. So Europe may be at a depressed point, Europe may be on very low valuations, but the global market as a whole, global industrial production, is not so depressed. This is not 2009. So the next slide just goes through and shows some of these companies that I'm talking about. So many top businesses, top brands in the world are European. And what we've got here is a list, and we've ringed the companies that are owned in the European Growth Fund. So there are many very strong businesses. Companies, BMW, selling luxury cars in China. Louis Vuitton selling handbags in China. SAP. Strong companies that have got global market positions, global winners that can drive growth not just from what goes on in Europe, but from what goes on in the globe as a whole. And that is how, despite the fact that European GDP has lagged global GDP, not just for the last 3 years, but for the last 30 years, European companies have actually seen faster EPS growth over the last 30 years, despite the fact that European GDP growth has been slower. And that's because European companies are not just driven by what happens in the European economy, they're driven by what happens on a global context. And that has been what's enabled them to deliver strong earnings growth even in this environment. The final point that I want to touch on when it comes to the asset class of European equities is the valuations. So we've described how European companies are not just driven by what goes on in the European economy, but are global businesses. Let's look at where the valuations are compared to other asset classes, other geographies, and compared to history. So if you look at, firstly, at the forward PE, the forward PE for the European market is amongst the lowest it's been for 25 years. It's higher than it was a year ago, but it's still very cheap on a 25-year view. Price to book is also below the average for a long-term 30-year view. The next measure down on the bottom left is the Schiller 10-year average PE. And what this shows is that the multiple you're paying based on the average of the last 10 years' earnings. And the reason why you want to do that is it helps to strip out cycles. So when you're at the top of an economic cycle, your earnings are going to be high and your PE will look lower. Whereas if you look at an average over a full 10-year period, you remove that cycle and you look at the longer-term earnings capability of a country, of an economy, of a stock market. And what you can see here is that on these long-term earnings, these cross-cycle earnings, European stock markets are significantly cheaper than the US. So the European market is on 13.7 times 10-year average earnings, whereas the US market is on 21 times 10-year earnings. That is a significant gap. Europe has only been cheaper than this 15% of the time. Okay? Over the last 30 years, we're only 15% of the time when Europe was cheaper than it is today. That number is 40% for the US. In fact, the valuation gap between the US and Europe has only been higher at the top of the tech bubble back in 1999-2000. European companies are cheap in a global context. The final point also looks at European companies against some of our fixed income colleagues and looks at the dividend yields that you get compared to the corporate bond yields. So we've heard how corporate bonds have performed very well. We've heard how yields have compressed. Well, what you see now is that more than half of the companies in the European stock market have a dividend yield that is higher than the investment grade bond yield that you can get. So you don't have to invest in high-yield sectors. You don't have to invest in telecoms. You don't have to invest in utilities. You don't have to invest in a company like Telefonica, who, in order to keep the credit markets happy, are cutting their dividend, selling assets, shrinking the business. You don't have to invest in a company like that in order to get a dividend yield that's higher than the bond yield. More than half the companies in the stock market have a dividend yield higher than the bond yield. That is a level that is, unprecedented compared to, well, for a very long history. We don't have it going back earlier, but that is a very, very long history. So it's not just one valuation metric that European equities look cheap on, it's many. Look versus history, look versus other geographies, look versus other asset classes. European equities look cheap. Let's talk about how I invest in European equities. What am I doing? So what I'm trying to do is find good quality companies on attractive valuations. That is the strategy of my fund, the European Growth Fund, and the European Larger Companies Fund, which I've been running since 2010. And this grid helps to show what I mean by that. And what it shows is a ranking of companies from low-quality companies over on the left to high-quality companies over on the right. And I look at each company in the European market and I will rank it based on its quality of its business model. So I will give it a ranking from 1 to 5 based purely on the quality of its business model. How do I do that? What am I looking at? What does quality mean to me? To me, quality is about the returns that a business can generate. So what I'm looking at is the return on capital that a business can generate. The higher the return, the more cash generative a business is, the faster it can grow without having to take on debt, without having to issue new shares. So a higher return company can generate faster total returns, faster growth, higher total returns for investors. But it's not just about having a high return company. It's looking for a high return company where there is some sort of barrier to entry, some sort of sustainability of those returns. Because the worst thing as an investor, as an equity investor, is for a company that's got high returns and competition comes in and erodes those returns and returns fall over the long term. That's not going to be a good investment. So what I'm looking for are high return businesses where those returns are sustainable in the long term, whether it be due to a brand, whether it be due to technology, whether it be due to scale that can't be replicated. I'm looking for some sort of competitive advantage that means that those high returns can be sustained in the long term. I then try and find good businesses, good quality businesses that are trading on attractive valuations. So it isn't simply looking for the best businesses. It's looking for the best trade-off of good quality businesses with good returns that are trading on attractive valuations versus a long-term history. So my sweet spot is down at the bottom right of this grid. High-quality companies where valuations are trading lower than their historical norms, where on a cross-cycle basis, not just on short-term PE, but on long-term measures such as price to book or EV to sales, valuations are below a long-term history, and we can see significant upside combined with the fact that it's a good quality company. Now, that doesn't mean that I can't find opportunities elsewhere, but that is the focus of the fund. That's my sweet spot and where the bulk of investments is going to be. Now, I can find some investments up at the top right in really good businesses with very strong fundamentals, where the valuation doesn't look cheap today, but where these strong fundamentals and strong growth makes the valuation look much cheaper within a couple of years. So a company up there may be Inditex. So when I started running money back in 2010, Inditex was a company that sat firmly in the sweet spot. Valuation was pretty low because people were worried about the performance in Spain and Inditex's exposure to the Spanish market. Valuation was low compared to a long-term history. Over the last 3 years, Inditex has re-rated. Inditex's stock price has risen very, very significantly over the last 3 years, partly due to the growth that it's achieved, but also due to a re-rating. People are much less worried about their exposure to Spain, and the multiple that you're paying for Inditex has risen from roughly 15 times to roughly 25 times earnings. So what you've seen is that the valuation has moved out of the sweet spot and up to the top right-hand side of this graph. Now, in the long term, Inditex, I think, can still be an attractive investment. But with the valuation where it is, it's a much lower conviction investment, and therefore it would be a tactical opportunity and not something that's at the core of my fund, a big position in the fund. Similarly, I can find tactical opportunities down at the bottom left. These would be lower quality businesses, but where the valuation is so cheap that the risk reward is still attractive. So the downside compared to trough valuations is limited, but if things improve, if economic conditions improve, if fundamentals improve, there is very significant upside back to normalized valuations. So an example down in that part of the portfolio might be some of the banks, where valuations got to very, very depressed levels, but they've obviously risen significantly over the last 6 months, but where they're still, below long-term averages. So you can find banks where valuations are still below long-term averages, and the risk-reward can be attractive. So the focus of the fund is buying good businesses on attractive valuations, not just the best businesses, but it's the trade-off attractive businesses, attractive valuations. So, let me move on. Why do I care so much about quality? What does this offer to us as an investor? Why should you care about quality? This looks at the relative performance of different levels of quality versus the European stock market. And what it shows is that the lowest quality companies in the red up to the highest quality companies in the green. And this is an analysis going back to the early 1990s, looking at the returns of a business, the strength of its balance sheet, and the sustainability using an accounting ratio. And this shows on the right-hand side the long-term performance of quality, why you should care about quality as an investment style. Higher quality companies deliver solid outperformance over the long term. Lower quality companies tend to underperform over the long term. In addition to that, you can see, as we've broken down the long term, the stock market cycle into different phases, a despair, a recession, a bear market, hope, that fast initial rally before economic fundamentals have started to improve, but where people are hoping that they will do. So like March 2003, like March 2009, to some extent like the second half of last year. Economic fundamentals in Europe haven't started to improve yet, but European markets have rallied sharply in the hope that they will do. The final stage of the stock market cycle, growth. We're in a growing economy, we're in a bull market for stocks. What you can see is that the higher quality companies, in addition to the long-term outperformance, reduce the downside risk in tough markets. So you get long-term outperformance combined with a reduction of losses, a reduction of risk in tough times, in tough markets. Now, the trade-off that you have to make for this long-term outperformance and reduction of risk is that when you move into this hope phase and the market rallies very sharply, these companies are going to go up, but they're not going to go up as quickly as some of the junkier companies that get lifted as the tide comes in and all the boats rise. So when you move into this hope phase, the lower quality companies will rally faster than the higher quality companies do. But that's to me, that's an acceptable trade-off. In order to get longer term outperformance, stronger long-term returns, with reduced downside risk, with reduced volatility in tough times, I'm happy to make that trade-off of giving up a bit of the upside when the market moves into this hope phase. So let's look at the actual returns that this strategy has delivered over the 5 years that I've been running it. Firstly, in the UK, starting in 2007, just before the financial crisis started, and then as we moved into Europe, and I took over the European funds in 2010. So you can see here that this quality strategy, this quality bias, has led to fairly consistent long-term outperformance. You can see in tough markets like the second half of 2008, when you move into this despair phase, very strong relative performance, reducing the downside losses. You can also see when the style has tended to underperform. Coming out of the bottom of the 2009 bear market, as the market moved into this hope phase, the market rallies 23% and the fund was up 21.5%. So we underperformed in Q3 2009. Similarly, in the second half of this year, as the market has moved into the hope phase again, and you've seen a very sharp rally in lower quality companies, you've seen a very sharp rally in some of the peripheral economies as people hope that the crisis is getting better. This strategy, this quality strategy, has delivered some underperformance. But if you add all of this up and look at the next slide, this takes exactly the same data. So these are exactly the same pieces of information, but just presented as a scattergram. So you can see here across the x-axis the performance of the index. So on the far left, when the index is falling sharply, and on the far right, when the index has risen sharply. And then on the y-axis, you can see the relative performance of the funds that I've been running with this quality style in each of those periods. So you can see the shape of performance. This quality bias helps to deliver stronger returns when the markets are weaker. But that doesn't mean that the funds automatically underperform when the market is rising. This isn't a low beta strategy, this is a high quality strategy. And that's an important difference to make. As you can see here, on average, when markets have been rising, we've been able to deliver modest outperformance. Now, when the market has moved into this fast rally phase, I'm likely to underperform. But on average, in rising markets, we've been able to deliver modest outperformance to add to the strong outperformance that we've been able to deliver in tough markets. So, the next slide here just takes that and puts that in context. So the European Growth Fund I took over in the middle of last year. The transition happened through the second half of last year, and the fund is now positioned in line with this quality strategy that I've described. So the larger companies fund is the fund that I've been running with this strategy over the last 2.5 years. And here you can see the performance of the strategy and how it's done. So you can see that over the last 3 months, in this hope rally phase, the fund has been third quartile, and over the last 6 months since the start of this rally, when Mario Draghi stood up and made his bumblebee speech in late July, the fund is just in the bottom quartile. But that is counteracted by the strong performance you get in different time periods. So over a 1-year time period, we're on the borderline of first quartile. Since I started running the fund in October 2010, we've beaten 96% of the peer group. And it's not just that this is in falling markets. The index has risen 15% over that period, and the fund has risen 26%. So this is a strategy that's designed to deliver long-term outperformance, reduce the downside risk in tough markets at the expense of giving up some of the upside in strong hope phases like we've seen in the last 3 or 6 months. So the next stage of the presentation is just to life a bit with a couple of stock examples. So the first example I'm going to give here is WPP. This is the world's leading advertising agency. To me, this is a very high-quality business. It's got very strong positions in emerging markets. It's number 1 in China, number 1 in India. Roughly 30% of its sales come from emerging markets, and these economies, these markets are growing at 10% a year for them. If you were a local business, if you were a Chinese business, and you wanted to build your brand, if you wanted to go international, would you go to the local advertising agency who could maybe build your brand in Shanghai and Beijing? Or would you want to go to WPP, who can build your brand in China, who can build it in Europe, who can build it in the US, who can build you as a global business? This company has a very strong competitive position in the emerging markets, very strong, good growth. It's also got a very strong position in online, in digital advertising. Again, roughly 30% of its sales come from digital advertising, and this area of the market is growing at high single-digit rates. So you've got a company that's got good underlying long-term growth drivers, but has got very high returns on capital, very cash-generative business, and where valuations are still very cheap. So it's trading on less than 12 times earnings. You're getting an 8 to 9% free cash flow yield, a dividend yield that is well above the corporate bond yields, and where its valuations are significantly below long-term averages. So this is a high-quality company trading on an attractive valuation. That stock is in my top holdings. Sorry. There we go. So the next stock example I'm going to give you is Sanofi, the global healthcare business. Now, investors worry about the patent expiries. Investors worry about patent expiries across the whole sector. But for Sanofi, these patent expiries are a minor issue now, and these products are only 7% of the sales of the business. So patent expiries have been happening, but are no longer a major issue for this company. And their growth businesses, like the diabetes franchise, like the emerging markets business, which is as big as their US business and growing at double-digit rates, are now 2/3 of the sales, compared to only 7% for the products that are going off patent. And these growth platforms give solid, recurring growth. So this is a business that can drive good underlying growth, again with very high returns, very high cash generation, again trading on a very attractive valuation compared to history, less than 12 times earnings, a discount to peers, and still very cheap compared to historic multiples of sales. This is a business with under-recognised growth on an attractive valuation, again, one of my top 10 positions. So, let's wrap up. Why do I get excited about investing in European markets? Why do I think the long-term opportunity is strong here? European companies are in much better shape than the European economies. They've got fantastic franchises, some of the best businesses, global brands, some of the leading businesses in the world are listed in European stock markets. European companies are very cheap compared to history, compared to other stock markets, compared to other asset classes. I can find lots of opportunities to buy good quality, long-term winners trading on attractive valuations. Thank you for listening.
Compartiremos ahora con todos ustedes los resultados de la encuesta, agradecer su participación. Hemos recogido muchas contestaciones tanto aquí como en la encuesta que hemos hecho online esta última semana a los miembros de Unience y de EFPA. Compartiremos a la vez los resultados de la primera y de la segunda pregunta. A la primera pregunta, que era de las categorías de renta fija, ¿cuáles creen ustedes que se ha comportado mejor? La mayoría han contestado deuda emergente. Como tengo que compartir estos resultados con nuestros gestores, permitidme que me dirija en inglés. Andrew, to the question we've asked our clients about which of the fixed income asset classes do you believe will be the best performing in 2013? First of all, the results are very consistent, which is good. And most of them have answered that the best asset class for 2013 will be emerging market debt, and to the worst asset class, govies. Now, compared to the Fidelity views and especially how Global Strategic Bond Fund is positioned, it seems our customers put on one side inflation linkers. You've mentioned a lot that given money velocity, also emerging market inflation, that this is an asset class that needs to be considered. Can you share briefly your thoughts on why linkers should be in a strategic but also in a tactical asset allocation from our customers?
Yeah, thank you. I think the numbers are very interesting, and they're broadly consistent. Sometimes you get a kind of caricature when you get these kind of surveys, and to some extent, whenever there's an answer that says 1%, that scares me enormously because that shows that everyone is on one side. And I like to be slightly kind of counter-cyclical, or so yeah, it's quite interesting. It's not surprising that people don't really like inflation, and the reason for that very often is that people invest looking over their shoulder rather than looking forward. And so if they haven't experienced a lot of inflation, it's likely that they won't see it as being a real concern. It's a typical way of investing. People look at previous returns rather than future returns. And the other one is it is a very, very complex asset class. It's highly technical. It is relatively unknown. And it comes with very little yield. And so you get people basically on inflation bonds don't get a lot of natural income. They're primarily government bonds, and they tend to get lots of duration risk. And so what we do is we try and manage that. We try and introduce potentially some high-quality corporates into inflation strategies to increase the yield. We try to reduce the duration because people don't want to buy long-duration assets. They're looking for inflation protection. And so we try and bring the duration down. But I think increasingly people are starting starting to think about it. It's interesting that the 10% who think that it could be the best performing asset class, will they actually go out and buy it? The chances are not, because having the conviction to do that is another thing altogether. The other comment I would make on the results is it's interesting. I would be more balanced between high yield and emerging markets. I think high yield still has a leg to run in a low interest rate environment, particularly European high yield. One of the interesting things around why high yield has performed so well is, to some degree, a bit of manipulation. What you had was a lot of bank debt that was subordinated bank debt that fell into the high-yield asset class as it was downgraded, and it gapped down in price very significantly. Similar thing happened when GM and Ford were downgraded in the auto crisis. And then as those bonds has recovered, they've performed very well. So what we've seen is very strong performance from subordinated bank debt that has been lifted in this environment that Matt described, where a rising tide lifts all boats, where everything comes up. But there's still lots of opportunity of good high-yield companies being run in an efficient way who are issuing debt at 6, 7, 8%. One word of warning, there was a European company that issued a bond in high yield, a double B-rated bond 2 days ago, at below 3%. And now, below 3% is not high yield by anyone's imagination. It may be sub-investment grade, but it's not high yield. So caution is there as well.
Thank you. The results of the second question we'll see are very much in line with what we've commented, which is... Segunda pregunta. Most of our investors think govies would be the worst asset class. If we move to the third question, tercera pregunta. Steve, this one's for you, and I'm glad to see our customers are aligned with our views, and here we don't have a big contrarian view, where, as you mentioned in your presentation, you favor emerging market local currency. Now, I'm going to ask you to dig a little bit into this bucket. Within your portfolio, which emerging market local currencies do you favor? And especially, we had a presentation here back in Q4 last year of our renminbi bond fund. You remember that over the last 18 months, both Fidelity and many of our competitors have launched China renminbi bond funds. So if you can give you your views on the best local currencies for 2013, but also the views on China renminbi.
Sure, okay. Well, when I look at the local currency, the makeup of local currency returns for this year, I think you can split it into two different categories. First of all, you have your duration return and also your FX return. And so, broadly saying that, you know, local currency is going to perform the best, I think you have to take those two into consideration. I actually think that local duration, you're just basically going to tread water and pick up your running yield. If anything, if treasury yields move higher, then it's going to have possibly some negative impact on capital values. But obviously the yield's still 4.5%, so you will make some positive returns there. Where I think the attractiveness of local currency debt this year is predominantly from FX, because as I pointed out in that chart, you saw a very strong correlation between FX returns and EM-PMIs, and our assumption is that EM-PMIs will continue to improve. So that should be one of the things that drives local currency. So within the asset class, I think this is a year for FX, not necessarily for duration. And then within the duration, I have to say, as I mentioned in the presentation, when you look at an index like the GBI EM Global Diversified, which is a local currency index provided by JP Morgan, this is a nominal index. And I think the trade is really, I know that inflation-linked bonds come out quite low on this survey as well. But what I really like is to have underweights in some of the nominal bonds in places like Turkey and Brazil and overweight linkers. So effectively I have a long break-even inflation trade there. Break-even inflation is still quite low in those two countries in particular, but I also like it in Thailand and Poland as well. So I think the break-even trade is a good trade to have on a local currency debt. Now, turning to the question of which currency we like this year, we have a framework where we look at different aspects of currency alpha. We look at fair value, we have a risk appetite model, which looks at the impulse, which currencies are going to perform well in different stages of risk appetite. We have a growth momentum index, a PMI impulse model, which looks at which currencies are going to do well at different stages of the growth cycle. We look at positioning, and we look at the basic balances and so on, some of the more fundamental valuations. And right now what we look at is that we think that there's a rising PMI trend here in an environment where risk appetite is pretty neutral if you look on the Z score. So the currencies that we like from this point of view are the likes of Mex peso, for instance, Malaysia as well. They're two currencies which should perform well. The Mex peso, unfortunately, is one of those currencies which everybody loves and position is quite high. But so I think this is a year where, like I mentioned, you're going to see some volatility, but that is one currency which I think, when you look at unit labour costs and wage costs in dollar terms, they're actually now cheaper than in the US. It's a fundamentally undervalued currency with a tremendous basic balance, which is just going to go through a new reform process for the labour market. So the likes of Mex peso, I think, Malaysia as well, with a tremendous basic balance, and it's very much an undervalued currency. We're going to see in March, after the elections, there's potential for very sizable inflows, privatisation inflows. So those two currencies in particular, I really like. Now, turning to the question of the renminbi, I love CNH bonds. I think we have it in our portfolio in the local debt side and also in the external debt side as well. It's, as Andrew mentioned, this has been kind of a slow grind of currency appreciation, and on top of that, you're getting some running yield from these bonds. So like a 3-year maturity bond is yielding around about 3.5%, and so I think CNH will continue to perform very well. It's going to be very much a political decision as to whether the renminbi will continue to appreciate. But I think there's still over the next 2 to 5 years or so, this is one currency which has to appreciate in nominal terms. So yeah, I really like CNH bonds.
Thank you, Steve. And to the last question number 4, which was addressed to Matt, which was the one about which region do you favour within Europe. Our customers have answered a vast majority of Spain and peripheral Europe. Matt, I know this risk-on answer wouldn't surprise you. Now, would you agree with that? And if you agree with that, where do you position Spain and peripheral Europe in your heat map? Would that be a sweet spot or something very tactical?
So the way I think about it is very much at a stock level, because a stock market index, because it's not tied purely to the performance of the country in economic terms, it's tied to the performance of the companies. And you can imagine that for Spain, companies like Santander, BBVA, Repsol have all got very large international businesses. So it's not just to do with what happens in the country, and therefore, I'd be placing the individual companies onto the heat map. What I can say is that I do find selected opportunities in both Spain and Italy. But I am modestly underweight the two countries in the fund at the moment. I can find more opportunities elsewhere. At the moment, I actually find the most opportunities in the UK. The point I would make maybe on some of the Spanish businesses is that you've seen a very large rally in the second half of last year, and where, for example, the Spanish banks were trading on very depressed multiples. They've actually re-rated back in line with their international peers. So Santander is trading on 1.4 times tangible book, the same multiple that HSBC trades on. BBVA trades on 1.3 times tangible book, the same multiple that UBS and Credit Suisse trade on. Popular and Sabadell trade on 0.9 to 1 times tangible book. That's the same multiple that BNP and Lloyds trade on, and a premium, quite a big premium, to where Barclays and Société trade on. So there isn't a material valuation argument on the Spanish banks at the moment. You need to think that the fundamentals are going to be stronger in order to want to be significantly overweight Spanish banks versus some of the other European banks. That being said, in Italy, the banks are on more depressed valuations still in price-to-book terms. So they are trading on around 0.5 times price-to-book compared to Barclays and SocGen on 0.7 and, as I said, some of the domestic Spanish and BNP trading on 0.9 times. So maybe there's more upside, more depressed valuations in Italy, although when you look at it on a price-to-earnings basis, we're all trading on about the same multiple of earnings because the profitability of the Italian banks is very low, both structurally and cyclically.
Thank you.
Gracias, Martina. Con este turno de preguntas concluye nuestro encuentro de hoy. Quería agradecerle a nuestros ponentes, a Steve, a Andrew y a Matt, su presencia hoy aquí, también las extraordinarias presentaciones. Las presentaciones ya están disponibles en nuestra página web, fondosfidelity.es, y quería únicamente pediros que dediquéis un minuto a valorar muy rápidamente lo que ha sido este evento para vosotros. Eso nos ayuda a nosotros a seguir mejorando. Y agradeceros, como siempre, vuestra presencia hoy aquí y espero que podamos contar con vosotros en nuestra próxima conferencia. Muchas gracias. Buenos días.
Búsqueda y selección de oportunidades allá donde se encuentren. Búsqueda y selección de oportunidades allá donde se encuentren.